I tend to avoid investing in payment processors as the industry just has so much competition with little to no moat. This has served me well these past 5 years as PayPal, Square, and Fiserv are all big losers. Shift4, though, is different. They specialize in serving the hospitality and entertainment verticals, which are high complexity, and they are able to succeed given their decades of experience in building the software integrations with hotels, sports venues, and restaurants' operating systems. Today, they are number one or number two in these verticals that they operate in and have over 200,000 merchants today processing 3.5 billion transactions per year. Their key to growth is they acquire smaller businesses with either a large merchant customer base or critical technology geographic reach. They will then cross-sell their full end-to-end unified payment platform to these merchants to replace the lower margin service offerings by the legacy business. Even though it is more costly, the customer has been willing to convert to Shift4's offerings, since Shift4's bundles is far superior and provides value-added services not available before. Most recently, we see that Shift4 deploy their strategy to acquire SmartPay Holdings. This acquisition gives Shift4 40,000 new merchants and deepens their strategic presence with expansion into Australia and New Zealand. Of course, Shift4 will now be offering their higher margin, full suite of integrated payments and commerce solutions to these customers now to convert many to the higher fee services. Looking at Shift4's financials these past 5 years, and this customer acquisition strategy has been working, revenue has grown at a 33% CAGR from 2019 to today to be at $3.8 billion revenue run rate. Even during COVID, when hotels and restaurants struggled, Shift4 had a slightly higher bump in revenue. Best part is this growth in revenue is matched by faster growth in gross profits, which has grown at 36% annually and is at $1.1 billion today. Now, the main reason Shift4 is able to cross-sell higher fee products to their acquired customers is their unified platform is simply better. In this example here for stadiums, a merchant would need to combine multiple systems together to accommodate tickets, mobile orders, concessions, parking, etc. This adds complexity and costs to their business. However, with Shift4, it is a single solution that can power this full fan experience from online and box office, ticket sales to concessions, retail to parking. By making the payment process more efficient, this shows up in higher sales and provides real-time analytics to help back office staff to really understand what's selling and divert resources in real time to these higher traffic areas. With a superior product for the target verticals, it is of no surprise that Shift4 is committed to midterm growth of continued 30+% revenue growth through 2027, marked by similar EBITDA growth. They're even seeing revenue growth grow without acquisition, with organic revenue growth being in the high teens. Because they are growing by acquisition predominantly, the best way to evaluate profit is to look at their free cash flow. And by 2027, they're guided to exceed $1 billion in adjusted free cash flow, up from $400 billion today. When put in a valuation for Shift4, it is important to note where it is in its business lifecycle. Even though they've been around since 1999, Shift4 is still early on in its growth journey. Until recently, they didn't have much international expansion opportunities, but today have opportunities in 75 countries. This is a company that is firing on all cylinders and can grow into now a $14 trillion total addressable market. The two main metrics for valuation will be a PEG ratio and a price to free cash flow valuation. For PEG ratio, they're currently trading at a 24 PE with growth outlook of 30+%, thus giving them a PEG ratio of 0.8, which is very good, as is below the traditional 1 for fair value. Assigning a price target for 2028, let's go with Shift4 just meeting their $1 billion free cash flow target, even though I believe they'll exceed it. In a bear case scenario, Let's assume they're compared with PayPal, a mature payment processor that prior to their new CEO failed to innovate within the past decade. Despite this, PayPal still trades at a price to free cash flow ratio of 11, which, assuming Shift4 matches this, gives Shift4 an $11 billion market cap in 2028. Not bad, as a 2x in 3-year scenario. In an absolute bull case scenario, Shift4 is compared with Toast, who is our main competitor in the restaurants vertical. Toast is perceived as a software and total restaurant solutions company versus just a payment processor, so they trade at an elevated price to free cash flow at a 40 price multiple. Now, assuming Shift4 gets this multiple, like Toast, and it is a $42 billion market cap, or 7x today's stock price. It isn't crazy, though, to imagine that Shift4 could have this 7x potential, because at a $42 billion market cap, they would only be trading at about a 5 times sales multiple, which Mercado Libre trades around this price multiple as well, from a price to sales, and they also have a similar constant 30+% revenue growth year after year. Overall, valuation looks solid. PEG ratios sub 1, and both the bear and bull case scenarios point to potentially market beaten returns. There are, however, two key watchouts that can impact Shift4 stock price in the short term. First is, since Shift4's customer base is tied to the hospitality and experiences vertical, a slowdown in the economy should disproportionately affect Shift4's client base. This is why Shift4 is trading 50% off its high, but I am not concerned long term, as Shift4 grew during the COVID pandemic and through the great financial crisis in 2008. Dollar cost averaging into the stock will be the key. Second watchout is going to be tracking the return on equity from the mega deal for Global Blue. Shift4 typically makes smaller acquisitions, but this was a $2 billion deal, which, with Shift4 being just a $6 billion market cap today, is pretty major for them. This deal, though, provides Shift4 a new vertical, luxury retail, and it gives them access to another $500 billion in total payment volume that they can upsell their unified platform to. So, we'll want to see positive updates in their earnings calls ahead that they're able to convert many of those customers to their unified platform. Now, before John runs through his technical analysis and I run Shift4 through my framework to determine whether we are buying, please read the disclaimer in the notes below. We are not financial advisors, and anything we say should not be considered financial advice. Also, if you like content like this, please help us out and click a like and subscribe, as we aim to analyze the most innovative companies twice per week. Now let's run Shift4 through my 5-point framework. From a leadership perspective, I give them a strong. The only reason this isn't a very strong is their founder, Jarek Isaacman, is stepping away for a few years to serve as chief of NASA. He won't be involved in the day-to-day, but as executive chairman, he still will be involved in any major strategic decisions. This is a leadership team that puts their money where their mouth is. Isaacman recently bought shares in the open market at $81 a share, and in the past year, Shift4 has rejected deals from private equity and also from Fiserv to acquire them at a price much higher than today. For valuation, this is a very strong. My bear and bull case scenario both exceed my 15% annualized return target. For revenue and profit growth, this is also a very strong. Multi-year guidance to continue the 30+% revenue growth, with more than half being organic revenue growth, is impressive. For total addressable market, I give this a strong. At first, I thought that they were too niche, just serving the hospitality and experience verticals in North America, but they've rapidly expanded geographies and today have a $14 trillion total addressable market. Their total payment volume today is around $200 billion, and that is minor compared to their $1.4 trillion cross-sell funnel that they are targeting from their acquired customers. For secular tailwinds, this is strong. The tailwind of digital and cashless payment methods is strong, and it will continue to grow globally. I am personally interested in seeing how, with the World Cup United States next year, how if that will give a slight revenue bump for Shift4 as they operate many of the stadiums that are hosting this event. Overall, I'm a yes on a buy for our community portfolio. The valuation seems too appealing right now, and this is a company that has demonstrated tremendous growth over the past decade, with guidance for it to continue. I was initially concerned that their payment processing can just be commoditized, but in covering them today, realized that their software integrations with their verticals operating systems is just too strong of a moat, and feel confident that they will have minimal enough customer churn, hence why they're guided towards high teens organic revenue growth. What do you think, Dad? Do you also agree that we can add Shift4 to our portfolio?
Thank you, Scott, for that excellent analysis, presentation, and examples. Yes, I like to do my framework for Shift4, symbol FOUR. Okay, for company fundamentals, the dividend has no dividend. The beta is 1.69, which means it's 69% more volatile than the S&P 500. The market cap is $6 billion, and earnings comes out February 17th, 26. So for that, it's neutral. For the earnings history, the last 4 quarters, it's beat 3 of the last 4 quarters. Like I mentioned before, that the company gives the analysts the projections and such, so they really should be beating it all the time. So uh, the earnings should always be beats. But anyway, it is what it is. So 3 of the last 4 quarters it beat. So that is a neutral to positive. And then for financials, the profit margin is 6%. Debt to equity is very high. It's 352%. They took out debt to buy what's that, something blue that Scott mentioned. So he took out a lot of debt to buy that. And then the PEG ratio is 0.8. The P's are around 24, and the earnings projection is around 30%. So that's a 0.8. So that's really low. If it's below 1, it's just really low for a company of this statute. So anyway, for that, it's a neutral. And then we go to the stock technicals. The moving average, the 200-day moving average is negative slope. The 50 is below the 200-day moving average, and the price is below both the 50 and 200. For the Bollinger Band, the volatility is pretty consistent. It's not high volatility or low volatility. It's pretty much neutral volatility. It's pretty consistent. It's between the lower band and middle band, as you can see. For the slow stochastic oscillator, it's 32, and previously it was just the last trading day before this was 18. And when it shoots through 20, 20 is the oversold mark. So sometimes when it shoots through 20, that's a good sign that maybe the stock will go up in price, which it did today. It went up around 7%. So anyway, that's a good sign. So and then the MACD is neutral, and the unbalanced volume is negative. So for that, it's a neutral. And then for analyst coverage, there's 2 strong sells, 1 sell, 1 hold, and 5 buys. And the price from the analyst range from 96 to 117. And analysts do the best they can, but who knows? Their guesstimate is just as good as ours, I believe. They have more data and more software, but nobody knows. So anyway, institutions is 130%, and that's an anomaly. You'd have to go on Google Gemini to ask why that they could have more outstanding shares, 130% of shares outstanding. Anyway, so that's a neutral. So bottom line for me, my opinion is that on the positive side, I like that the PEG ratio is so low and the price is pretty low. PEG ratio being 0.8 is very good, like I've mentioned, and the price is low. So that's the positive. The negative is that it can get hurt in a recession because it's, as Scott mentions, it's mostly stadium venues, experiences, hotels, restaurants. So you can get hurt in a recession. And there's also, they have a lot of debt. and it's very competitive. But on the positive side, I like that the PEG ratio is so low, and that the slow stochastic oscillator just penetrated 20 going up. So Scott, I would say let's, I'm a yes, but a partial position. Let's do a quarter position for Shift4. So that's my take on it, Scott. So back to you.
Thanks, Dad. Overall, we are both a yes to add Shift4 to our community portfolio. The valuation is just too appealing right now, coupled with our continued growth outlook. With that said, thank you for watching. Please help us out and click a like and subscribe as we aim to analyze the most innovative companies twice per week. Until next time, happy investing.